In 1957, Germany made a promise to every worker: pay into the pension system, and it will take care of you for the rest of your life. That single promise shaped how tens of millions of Germans planned their entire working lives. But the German government's own newest report shows something the average worker has not been told clearly. The contribution rate is projected to climb from 18.6% today to over 21% by 2039. And the pension level, the share of your last income you actually get back, is set to shrink for the first time in decades. So what really happened to Germany's pension system? Why has it been rebuilt again and again, and what does it mean for the money in your own retirement? This isn't a story about politicians arguing on television. It's a story written in real numbers from Germany's own pension insurance office, its finance ministry, and its statistics office. It starts in 1889, when the very first version of this system was built for a completely different Germany. And it leads all the way to 2025, where a shrinking younger generation is now being asked to support the largest number of pensioners the country has ever had. Along the way, the rules changed 6 separate times, each one quietly reshaping what retirement means for a German worker. By the end of this video, you'll understand exactly why your pension looks the way it does today and what the country's own experts say needs to happen next. Let's start at the beginning, in a Germany most people alive today never knew. In 1889, Germany introduced the world's first national old age insurance system under the Invalidity and Old Age Insurance Act. Back then, the pension age was 70, at a time when most workers never lived long enough to collect a single payment. The contribution rate was just 7%, because this wasn't designed as a retirement plan for the middle class. It was designed as a narrow safety net, mostly to stop destitute elderly workers from becoming a burden on the state. In 1911, a new law called the Reichsversicherungsordnung expanded the system, adding protection for widows and children for the first time. Slowly, pensions stopped being just an old age patch and became a real pillar of German social insurance. But the system that most Germans think of as the pension didn't actually exist until 1957. That year, the Bundestag's own research describes what happened as a permanent turning point. Pensioners were, for the first time, deliberately linked to wage growth so retirees could share directly in Germany's post-war economic boom. Overnight, a pension stopped being basic subsistence and became something closer to a second income, tied to how well the country's workers were doing. What most people don't realize is that even in 1957, this wasn't purely funded by workers' contributions. Germany's own pension insurance office confirms that federal subsidies already made up about 24% of pension revenue the moment this new system began. That detail matters, because it destroys a myth many Germans still believe, that the pension system was ever purely self-funded by payroll contributions alone. It never was, not even at the start of its most generous era. By the late 1960s, a recession made it clear that Germany couldn't keep building large financial reserves for pensions. So in 1969, the country fully committed to what's called a pay-as-you-go system. In simple terms, that means today's workers directly pay for today's retirees, instead of each generation saving up its own pension fund. This became known as the Generation in Vertrag, the generational contract, an unwritten deal between the young and the old. It only works if there are enough young workers to support the retired population, a condition Germany once had, but doesn't anymore. In 1972, the system expanded further, opening pension coverage to the self-employed and to housewives, and allowing retirement from age 63. Retirement kept getting easier and earlier to access, and Germans took full advantage of it. By 1982, the average pension entry age had dropped to just 62, 3 for men and 61, 5 for women, the earliest it has ever been. That was the peak of the generous era, and it was also, mathematically, the beginning of the problem. In 1992, Germany passed its first major reform explicitly justified by an aging population, slowly raising the retirement age threshold towards 65. Even then, policymakers still tried to protect a 70% net pension level, refusing to accept that public pensions might have to shrink. But cracks kept appearing. In 1997, Germany introduced financial penalties for early retirement, and it worked. The falling retirement age finally stopped dropping. Then, in 2001, came what the Bundestag itself calls a genuine paradigm shift. For the first time, policy stopped trying to guarantee a target pension amount, and instead started protecting a stable contribution rate. In plain language, the government decided it was no longer willing to promise a fixed pension outcome, only a fixed cost to workers. That meant the public pension level was now expected to decline over time. by design, not by accident. To soften the blow, the same 2001 reform created the Reister pension, a government-subsidized private savings plan meant to fill the gap the public system would leave behind. Then, in 2004 and 2005, two more changes locked in this new direction. A sustainability factor was added to the pension formula, permanently slowing down how fast pensions grow, and Germany also switched how it taxes pensions, changing the tax bill for future retirees. And in 2007, the government legislated the biggest change of all, gradually raising the statutory retirement age from 65 to 67. That transition started in 2012, and it won't be fully complete until 2031. If you are a German worker under 60 today, this single law from 2007 is quietly still shaping the exact age you'll be allowed to retire. In less than 15 years, from 1992 to 2007, Germany rewrote the basic rules of retirement 3 separate times. And every rewrite pointed in the same direction. Work longer, expect less from the state, and save more yourself. But the story isn't just a straight line of cuts. Politics pushed back too. In 2014, a new pension package partly reversed the pressure, creating the Rente mit 63, allowing especially long-insured workers to retire at 63 without penalty. It also expanded pension credit for raising children and improved disability pensions. In 2019, the Rentenpact set a clear political floor, promising the pension level would not fall below 48%, and the contribution rate would not rise above 20%, at least for a limited time. In 2021, the Grundrente, a basic pension top-up, came into force, recognizing something uncomfortable. Long careers were no longer guaranteeing an adequate pension for many low earners. And there was one more, quieter story running in the background the entire time. After German reunification, pension values in the former East Germany were calculated differently from the West, a gap that took over 30 years to close. That legal gap finally reached full parity in July 2023, with the remaining calculation differences completed by 2025. So by 2025, on paper, East and West Germany finally share one unified pension formula, more than 3 decades after reunification. That's the full arc, from a narrow 1889 safety net to a generous 1957 wage-linked promise to a 2001 paradigm shift, and finally to today's fragile balancing act. Now let's look at exactly where that balancing act stands right now in real numbers. As of the government's newest official report, the contribution rate sits at 18.6% of your gross salary. The pension level before taxes, meaning the ratio of a standard pension to average wages, stands at 48.0%. And the monthly gross standard pension, the benchmark figure the government uses, is 1.8. Here's the part almost nobody explains clearly. That 1,036 figure is not what a typical new retiree actually receives. It's a theoretical calculation based on 45 years of average earnings, a career length very few real workers actually match. We'll come back to what real retirees actually collect in a moment, and the gap will surprise you. For now, focus on where these numbers are heading. The same official report projects the contribution rate rising to 19, 8% by 2028, 20, 1% by 2030, and 21, 2% by 2039. That's under the government's own middle case scenario, not a pessimistic one. At the same time, the pension level is projected to hold at 48% only until 2031, before slipping to 46, 3% by 2039. In other words, today's political promise to protect the pension level mainly delays the squeeze, it doesn't eliminate it. So why is this happening now, after decades of the system holding together? The answer isn't political, it's biological and mathematical. Germany's population reached 83.6 million at the end of 2024, and 40% of the working age population, people aged 20 to 66, are already older than 49. That means the very people paying into the system today are themselves approaching retirement, with a smaller generation coming up behind them. Since 1990, the number of Germans aged 70 and older has grown from 8.0 million to 13.7 million, an increase of 5.7 million people in just 34 years. Life expectancy tells the same story from a different angle. Back in the 1870s, life expectancy at birth in Germany was just 35, 6 years for men, and 38, 5 years for women. Today, it's 78, 5 years for men, and 83, 2 years for women, more than double. Even more telling, a German man who reaches 65 can now expect another 17, 7 years of life, and a woman another 20, 9 years. When the retirement age was fixed at 65 decades ago, nobody expected people to collect a pension for close to 2 decades afterward. On the other end, births are collapsing. In 2024, Germany recorded just 677,117 births, the lowest number since 2013, and a quarter below 1990 levels. Germany's fertility rate now sits at 1.35 children per woman, far below the roughly 2.1 needed just to keep the population stable. Immigration has softened this, but only partly. Net migration was about 430,000 in 2024, actually down sharply from 63,000 the year before. And for the first time since 2008, Germany even lost more people to the rest of the EU than it gained. Put all of this together, and the OECD projects Germany's working age population will shrink by 23% over the next 40 years, nearly double the average decline across other wealthy nations. The European Commission puts it in a single number. The ratio of pensioners to workers is projected to rise from 0.50 in 2022 to 0.70 by 2050 and 0.80 by 2070. Now, let's go back to that gap we mentioned earlier, because this is where the story gets personal. The government's official standard pension is $1,000, but the average newly granted old age pension in 2024 was only $154 a month. And that average hides an even bigger split. Men received $1,340 on average, while women received just $981. That's not a small rounding difference, that's a gap of 27.1% between what women and men collect overall. Once survivor benefits are set aside, the gap widens to 39.4%. It's also deeply regional. In the former West Germany, the gap reaches 31.5%, but in the East, it's only 6.1%, because East German women historically worked full-time far more often than women in the West. There's a similar East-West split in how much people depend on the state pension altogether. In the East, the state pension still makes up about 90% of total retirement income, compared to just 64% in the West, where private and workplace pensions play a bigger role. And for a growing number of older Germans, even these numbers understate the real risk. As of the latest data, 19.5% of people aged 65 and older are classified as at risk of poverty, with women at 21.3% and men at 17.3%. The poverty line here is $1,045 net per month for a single person. And the number of retirees needing basic old age welfare support has been climbing fast, up 7.1% in a single year, and 31% since 2020. So while headline averages sound survivable, real retirees, especially women and those in the West, are often living much closer to the edge than the official standard pension number suggests. It's worth asking, is Germany's situation unusually bad, or is this happening everywhere? The OECD's newest comparison gives a clear answer. Germany's current normal retirement age is 64.8, lower than Sweden's 65, 0, the Netherlands 67, 0, and the UK's 66, 0, though higher than France's 62, 5. But look at where things are heading. For a worker starting their career today, the future retirement age is projected at 67 in Germany, and a striking 70 in both Sweden and the Netherlands. Here's the number that should worry German workers most. The projected future net replacement rate, essentially the share of your income your pension will replace, is only 53% in Germany. Compare that to 88.5% in France, and 96.0% in the Netherlands. Germany actually spends more on public pensions as a share of its economy, 10.8% of GDP, than the Netherlands at 6.4%, or Sweden at 8.0%. So Germany is spending heavily, but delivering a lower replacement rate, because so little of that spending flows through funded, invested retirement assets. Retirement assets in Germany amount to only 6.4% of GDP, compared to 115.8% in Sweden, 159% in the Netherlands, and over 150% in the United States. So what do Germany's own economic experts say needs to happen from here? The German Council of Economic Experts projects that, under current law, the pension level falls to 47.3% by 2035 and all the way to 44.0% by 2080. Over that same period, the contribution rate is projected to climb to 29% by 2035 and 24.1% by 2080. If politicians instead choose to freeze the pension level at 48% permanently, the Council's own modeling shows the contribution rate would need to reach 26.0% by 2080 to pay for it. Germany's central bank, the Bundesbank, ran a similar calculation and reached an even starker number. Without raising the retirement age, contributions could need to climb toward 29% by 2070 just to hold the pension level at 48%. Their recommendation is direct. Link the retirement age to life expectancy after 2031 and phase out the deduction-free early pension for long-insured workers. Under that kind of link, the Bundesbank estimates the retirement age would need to rise to well over 69 by 2070. Separately, the Council of Economic Experts recommends what's called a 2-1 rule. For every extra year of life expectancy, people would work roughly 8 more months and enjoy 4 more months of retirement. Both institutions also push the same second idea. Build a much stronger funded pillar, essentially real invested savings, through automatic enrollment with a target saving rate around 4%. But even the Bundesbank is honest about the limits of that fix. A funded pillar takes decades to build up, so it cannot rescue today's contribution rate crunch on its own. In short, there is no expert plan that avoids trade-offs. Every credible projection agrees that Germany cannot keep retirement ages low, contributions low, and pension levels high, all at the same time. So here's the real lesson underneath every reform we just walked through from 1889 to today. Germany's pension promise wasn't broken once. It was quietly renegotiated at least 6 separate times, always in the same direction. Work longer, expect less from the state, and take more responsibility yourself. The workers who came out ahead through every one of these shifts weren't the ones who trusted the old promise to hold. They were the ones who started building a second pillar of income long before the rules forced them to. But knowing these numbers is only step one. The harder question is, what an aging population, a shrinking workforce, and a fragile pension formula actually mean for your own retirement date and your own monthly income. That's exactly what we break down next, so if you want to see how these exact trends translate into real retirement numbers for someone your age, watch the next video, it's linked right here.